Assalamualaikum warahmatullahi wabarakatuh to Sir Syamsul Samsudin and everyone. My name is Nurisa Biha binti Zulkifli. So today I would like to present my individual assignment, which is about the capital structure. Let's get started with the introduction. The study of capital structure seeks to explain how listed corporations use a combination of different types of securities to finance investment. Under certain restricted assumptions, Modigliani and Miller established that capital structure is irrelevant. Since then, numerous researchers have addressed the study of corporate capital structure with less constraints. This has led to the proof of the existence of an optimal capital structure choice. Unfortunately, researchers have not reached an agreement on what the optimal capital structure is. However, it is vital to synthesize the research on capital structure and if feasible, relate it to existing empirical facts. So, what is capital structure? Capital structure is the particular combination of debt and equity used by a company to finance its overall operations and growth. A firm's capital structure is typically expressed as a debt to equity or debt to capital ratio. Debt and equity capital are used to fund a business operations, capital expenditures, acquisitions, and other investments. Furthermore, capital structure also is the composition or structure of a company's obligations. Here, we will see at how changes in capital structure affect the value of the firm or else equal. Next, the simple definition of optimal capital structure is the proportion in which its stock and debt are created. Besides, one of the objectives of optimal capital structure is to find the optimal balance between increasing a company's wealth and value while lowering its cost of capital. Furthermore, when choosing a capital structure, a company must find the lowest WACC as it was one of their goals. There are three important factors when creating an optimal capital structure, which are wealth, net worth, and market value. It will be maximize an appropriate capital structure. The present value of future cash flow is used to calculate the company's wealth. The optimal capital structure should be easy to structure and comprehend. A complex capital structure will just create confusion. So next, we will talk about the steps that must be taken in order to determine the optimal capital. There are 4 steps. So first, look for different capital structures with different debt to equity ratios. Second, calculate the cost of capital and the cost of debt at different levels of capital structure. Third, calculate the weighted average cost of capital or WACC. And last one, through the use of graphs, we may achieve the optimal level of capital structure. There are lots of factors that affect the capital structure and capital structure decision, but here I will only discuss 4 factors among all of it. First and foremost is the size of the company. Due to its weak credit worthiness, small businesses have a difficult time raising funds and the investors are hesitant to put their money into this company's securities. Next is age of the company. Because of their ability to persist for a longer period of time, older companies are thought to be more stable and thus more trustworthy. Furthermore, profitability is also one of the factors involved, where the higher the operating profit ratio, the higher may be debt ratio, because in that case, the chances of not meeting interest costs will be low. Last but not least is the growth prospects, which firms with constant sales can use a lot of leverage because they would not have any trouble keeping their established commitments. In this slide, we will discuss about the financial distress. Financial distress is a word used in corporate finance to describe a situation in which a company's agreements to its creditors are breached or are only partially met. Some of the reasons for this financial distress include large fixed costs, a high percentage of illiquid assets, or revenue that is vulnerable to economic downturns. There are warning indicators that a firm is in financial trouble, such as low profitability, which may indicate a financially unstable company. Second, sales are decreasing. Dropping sales indicate that there is no demand for our goods or services based on the company's present business. If a firm produces low quality products or services, customers will continue to buy elsewhere, and the company will finally be forced to shut its doors. And last but not least, when debtors wait much too long to pay their obligations, cash flow may become severely constrained. As a result of this problem, the corporation may be unable to satisfy its own obligations. The term distress cost refers to the cost incurred by a company in addition to the cost of doing business. As an example, consider a higher capital cost. Not only that, a corporation in financial distress has a harder time honoring its obligations. As a result, the risk of default increases. Distress cost is broken down into two categories, ex ante and post ante. Ex ante, which means before the event, where higher borrowing costs will be incurred since lenders will demand higher interest rates from businesses in financial difficulties. Second, post ante, which are after the event, where it comprises the expense of declaring bankruptcy and assembling attorneys and accountants for the bankruptcy proceedings, as well as other administrative costs associated with corporate dissolution. Next slide is the integration of tax effects and financial cost distress. In this graph, we can see that when the present value of financial distress cost grows, so does the present value of debt tax shield. As a consequence, we can observe how they are related to one another. According to the findings of the study, a firm's worth increases as it begins to shift away from equity and toward debt due to the present value of the lowest distress cost. In this example, the likelihood of distress is modest or low. As a result, each modest increase in the value of the debt raises the present value of these charges. Some people will experience a rise in the present value of their tax shield. In this situation, bankruptcy will occur quickly as a result of tax shield, resulting in a loss in corporate value. When there is a conflict of interest that emerges between management and shareholders, this is referred to as agency cost of equity. This conflict is occurring due to a conflict of interest between the shareholders and the management. For example, management may believe that a merger would be the best step forward for the business, whereas the shareholders see that the merger would not help grow the business and the money spent on the merger could be better used in paying dividends and investing in other areas. The costs associated with stopping the merger, such as lobbying, would be the agency cost of equity. This pecking order is significant since it informs the public about the company's performance. When a firm finances itself internally, it indicates that it is stable. When a firm finances itself through debt, it indicates that management is confident in the company's ability to make its monthly obligations. If a firm supports itself by issuing additional stock, it is usually a bad indicator since the corporation believes its stock is overvalued and wants to earn money before its share price falls. Now we will look at the pecking order hierarchy theory. In Internal financing is the first option where the company's owner prefers it since it is easier to acquire cash and the initial finance setup expenses are minimal because no bankers are involved. Even if internal searching is simple and quick, there are certain reasons why it is not encouraged. One of which is that the risk of loss is still transmitted to the companies. Second, there is external funding which may be done in two ways, by taking out the loan or by selling a piece of the company's stock as equity. To begin, that is when a company takes out a loan to raise the necessary funds, whereas equity is the most costly financing choice. Equity capital such as stock shares has a greater cost of capital than debt capital. This slide is about signaling hypothesis where when both managers and stockholders have the same information. This is referred to as a signaling theory, systematic information. In practice, managers are more knowledgeable than shareholders or investors, which is called as asymmetric information. The capital structure of the firm is optimized so that the marginal subsidy to debt matches the marginal cost. That's all from me, Nuri Sabir Zulkifli. Thank you so much, everyone. Bye bye.